Peter McGuire, CEO at XM.com Australia, now joins us from Mumbai. He's on a visit to Mumbai and he's joining us to give his view. Peter, thank you so much for taking out time for us. Could you just tell us what is your view on the crude? 10 days back it was looking as if it can go to 65, 70, but suddenly you get data, you get production news flow which has taken crude down.
Yes, I mean, good morning and thanks for inviting me on the show. It's been a dramatic 6 or 7 days of trade. And when you consider that meeting last week in Houston, you had money managers, hedge funds and OPEC producers and non-OPEC producers, and the other side, their shale participants. Everyone was considering that you may see higher from here, and now we're sitting a week later. You've had the price certainly wash out. You've got crude trading, that 47, 48 sort of handle for WTI. Pressure to the downside. What happens with Janet tonight if she does? We do see a rate rise out of New York, and the whole momentum seems to have been very much, sold out. So we're 2 months away from the OPEC meeting, 25th of May in Vienna. And we saw the Saudis, of course, that statement increasing production to over 10 million barrels, up 200,000. So that's going to be a very fascinating next couple of weeks.
Right. So, crude from the lows of 22, 25 that it hit earlier last year has given a fantastic return up to $60. What will be your view now for crude? Where do you think crude would go? What will be the range in which crude can, trade at?
Well, I think that considering where the US dollar, and if we see that rate rise, I think you're going to be probably at these sort of levels. You may see a little bit further downside pressure due to the amount of rig count that's coming through from Baker Hughes. It's just a never-ending story in the sense of bullishness. More rigs coming online, and of course through technologies and innovations they've been able to cut costs. The other side, of course, is those other non-OPEC producers. If Saudis are raising production, the likes of Libya that weren't involved in the cuts, what's Russia going to do? Demand picture coming in for that Northern Hemisphere's traditional summer driving season. What impact that's going to take to the market. So I think with the current pricing, you may see a little bit of oscillating between the 47s to say 50 for WTI until you see some definitive breakout.
Right. You mentioned about the Fed meet today and what can be important for crude. This time around dollar index has gone up and so has the commodity prices. Did that surprise you?
Yes, it did. I mean, when you're thinking about what the positioning is of the market, we've seen, if you look at the CRB, the index there, I think over the last week or so, saw a dramatic washout, and you saw grains down, agriculture, precious metals, base metals and energy all took a severe washout. So in turn, I think that you'll probably see some consolidation amongst these prices. I keep a close eye on iron ore pricing as well, naturally being an Australian, but more importantly, I think we're down to around about 2004 record levels as far as China stockpiles, 130 million tonnes sitting on wharves and of course in warehouses in China. So if that iron ore market starts to take a bit of a hit to the downside, I think that it'll carry the usual suspects down, copper and so on, and some of those other base metals. So that's where I think a lot of traders are keeping a close eye on China consumption and so on, and of course energy, precious metals and US dollar.
Right. So, say if Fed was to hike or the dollar index were to strengthen from here on, how do you expect commodity prices to react?
Well, I'm conscious that if the US dollar does rally and it gets stronger, and if we see consecutive rises, let's say we see 3 this year, I think that'll certainly put a little bit more pressure on the US dollar to the upside naturally. Bond yields will increase, but more importantly, you quite simply could see a softening as far as a number of those key base metal markets and of course precious. The uncertainty is what happens. We've now got to take our focus across to the UK. Theresa May saying yes, we're moving ahead. Article 50, Brexit. What happens with Scotland? Where does the Dutch, we've got the election within a matter of days. The next point, of course, is what happens with France and Marine Le Pen and then Germany. So this year, I think, will be one of the most volatile, certainly over the last few years, comparing it to, for currencies and for precious metals. So I think a lot of traders are very wary of what the outcome's going to be, and they're keeping their hands certainly on the wheel.
Right. Last year, same time when we spoke to you, one of the big worries for commodities was that what happens to these commodity companies, the debt that they have taken, the bonds that they have issued. You think at least now that is behind, so it may not be as volatile as 2015-16 was?
Well, if we look at the energy sector, and that was certainly hammered to the downside, WTI at that mid-20 mark, Brent not much higher, that certainly created a lot of discontent amongst capital expenditure for oil exploration companies, and I think it probably put an undertone in the market as far as that Saudi Aramco IPO. That's only about 12 months away. We've got the due diligence, working through that now. Valuations are going to be anywhere from 500 million, I've heard, or 500 billion, I should say, all the way through to about 2 trillion. We're going to examine closely the amount of reserves that Saudis have. I haven't seen a revised number since about 1989, so that's nearly 30 years ago. And the next point, of course, is the consideration that a lot of these, certainly countries and companies, have been greatly hammered due to the price of commodities. So in turn, it's a little bit of a rebound at the moment for the BHPs and the Rio Tintos and the Vales and so on. But when you take on board price volatility and what can happen over the next 3 to 6 months, I think many CFOs have got a very close eye as far as forecasted numbers and what's happening to their balance sheet.
Peter, what about what do you make of the action happening in China, where some of the capacities are being shuttered? They're saying 6.5% growth is not such a cakewalk. It will take effort. Do you think that some of the base metals like copper, iron ore will not really crack too much? Will they remain stable and then, according to supply demand, perhaps move up higher? What's the outlook for base metals?
Well, I think, this time last week, early part of last week, we were at 6,100 metric tonne for copper, now around that 57-odd. There is certainly downward pressure, and I think the crude, and certainly we're waiting to see what happens as far as Janet. The 6.5% forecasted numbers moving forward for China is, I think, achievable. If you do believe the numbers, and it's very hard to, with such a large consumption and naturally, an engine to the world, I really think that if they can achieve those sort of headline numbers, I think the government's going to work as hard as it can, and they realise that they need that sort of number to maintain employment and all the natural occurrences from that. You possibly could see a little bit cheaper as far as some of those base metals, but in turn, if the infrastructure spend and what President Trump is certainly heralding, I think that will come into play, second quarter moving forward, and we're going to see a really strong uptick. If he's committed, if he does half of what he says he's prepared to do, then that will mean a great demand for every base metal across, of course, to energy. And I think we're going to go through a very solid growth and infrastructure rebuild across North America.
Right. What's the outlook for gold as well? Gold is just around $1,200 a barrel. The Fed meet is being eyed quite closely, but if inflation really starts to look up globally, if this entire reflation trade works out as what people are expecting, what does that do for gold then?
Well, you would think it'd push it higher. I mean, the uncertainty this year as far as those the elections in the EU, and you're worrying about, the US dollar, of course, inflation. I think that will all be undercurrents to push gold higher. In the short to medium term, I really don't think you're going to see a sub-$1,000 gold. I think those days are long behind us, but who knows? I mean, sometimes you can see dramatic things happen in these markets. But I feel as though, it's that $1,150 to $1,300 trade. It's been very volatile since late October. You only put a graph up and you'll be able to see that those moves over that period of time have been quite dramatic. So it's probably taking a bit of a breather. If we do get those 3 rate rises this year, then that's going to put pressure to the US dollar. As far as inflation, I think the energy markets will probably stay at these sort of levels. So you may not see high fuel inflation, food costs and so on. You're actually seeing cheaper food, so that I don't think will push it too high. So at the present, we're just sitting on our hands. I think it's going to trade in that sort of $1,150, as I mentioned, to $1,300 band.
Right. What do you think? Do you have a view on the dollar as well? Where do you see the dollar index? People are watching this Fed meet very closely. What if the Fed doesn't move to hike interest rates but gives a very hawkish commentary? Where do you see the dollar headed then?
Well, you know, the next 24 hours are going to be crucial. I'm more suggesting that they possibly will raise for that one time. Let's see what happens over the foreseeable, you know, next couple of months. We've got some analysts and some commentators saying that they could have seen 4 rate rises this year. I think that's probably, you know, 1 too many or 2 too many. But, you know, the Fed's got its own mind. They've got those strong unemployment numbers will probably be revised up in the next couple of weeks from last Friday night. So the overall growth coming out of the States is very, very strong. Where it happens as far as US dollar index, it'll probably push higher from here. I think it's just a natural momentum, considering that, you know, more funds will flow in with higher interest rates in the States. So that will capture more capital, and in turn, I think you're going to see a stronger US dollar.
Peter, as far as you know, what's happening with the spending in US is concerned and the trade barriers, these are also 2 important triggers. Both could be quite meaningful as far as commodity prices are concerned.
Absolutely. I mean, the uncertainty, there are so many, and that's where so many analysts and I think commentators are really having to sit on their hands a little bit, quite simply because it's an unknown as far as the new presidency, what they're prepared to do as far as trade. There's talks, and it's pretty much a week-by-week proposition. The president is in his 2nd month term, where he'll achieve a great deal, I think, over his first 100 days, and probably just settling very much into the saddle to make things more effective. As far as trade barriers, and we all understand, you know, what possibly can be on the agenda, it's still a very much a wait-and-see approach, because quite simply, you can't second guess what the administration is prepared to do. You can only sit back and just, you know, take it on board, breathe it in, and just go, okay, well, that's the next part of the journey. So I think that's why 17 could be a very volatile year in so many factors.
Peter, thank you so much for taking out time for us.